Silver's banging up against this $30 level, which has contained it now for almost 4 years. Gold broke out of its range back in March and immediately shot more than 10% higher, right? And it's still up here. Did that break silver out? No. Okay, well, maybe if gold goes higher, it will. Well, what else could drag silver kicking and screaming? Gold goes higher because of what Powell's doing, all this kind of stuff, and goes to, say, 2,500. And if copper goes to $6 a pound, silver's not going to stay at 28, 29. Okay, it's just not. And so when it finally gets dragged kicking and screaming through that resistance level at 30, there's a really high likelihood it'll go to 34, 35 in relatively short order. That's going to have big impacts on the mining shares, and that's all something people should. So watch copper closely in the days ahead.
In April, gold briefly surged above $2,400, reaching a high of $2,431 before experiencing a sharp intraday reversal on April 12th. Despite this setback, gold found support bolstered by factors such as the Federal Reserve's stance, demand from Asian buyers, and softer inflationary pressures. CraigHemke from Sprott Money Weekly Wrap-Up noted the potential for a double top formation in gold's chart, which could serve as a defensive measure for banks with short positions. He suggested that silver will likely follow suit if gold and copper prices continue to rise, possibly breaking through its long-standing resistance level of around $30. Silver saw its best settlement over 11 years, fueled by U.S. government data indicating lower than expected consumer price increases in April. Analysts like Citi Index's Fawad Razaqzada anticipate silver surpassing the key $30 level, with the path of least resistance remaining upward as long as certain technical support levels hold. Hemke also highlighted the potential impact of rising silver prices on mining shares, which could experience significant gains. However, he cautioned against excessive market excitement, noting that such sentiments often precede market peaks. Despite a $150 correction in gold prices, mining stocks have shown limited downside, suggesting a mean reversion in the sector. Furthermore, Federal Reserve Chair Jerome Powell's emphasis on monitoring the labor market and indications of potential future rate cuts in response to weak job reports has contributed to traders' growing confidence in the possibility of interest rate cuts as early as September. This anticipation could have implications for precious metals prices in the coming months. Join us as we delve into CraigHemke's insights. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
Go back to the middle of April, 5 weeks ago or so, gold got up to about 24.20-ish. Silver got within a whisker of 30.
Hair's breadth, yeah.
Yeah. And then, pulled back, some natural resistance there, especially in silver. And now here we are getting back those levels. I would anticipate an effort made to paint the charts with a double top sometime in the next week or two, just as a line of defense for all of these banks that have all of these shorts. I mean, again, when you're at an all-time high, every short is underwater. Every short ever created is underwater. So that has to be managed. So I would anticipate that. But, Powell, Kerry, when back at the March FOMC, interviews that he did after that, and then again at the May FOMC, said he is watching the labor market real closely. He knew that they hiked too late and inflation got away from him. He doesn't want to cut too late and have the economy tank. And so he has said, and I'm paraphrasing, but anybody can look this up. He has said repeatedly that if he senses weakness in the labor market, they will cut. They'll put inflation on the back burner and they'll cut. Well, we're starting to see that. The latest jobs report was weak. Some of the internal stuff over the last couple of weeks has been weak. So if we get now into the summertime and all of a sudden the Fed does cut or start actively talking about cutting, any double top painting by the banks isn't going to hold. And that's what we'll look for next.
That'll be the signal.
Copper is a very interesting story. And we're going to relate this all eventually back to silver, right? Because silver's banging up against this $30 level, which has contained it now for almost 4 years. Okay. Gold broke out of its range back in March and immediately shot more than 10% higher, right? And it's still up here. Did that break silver out? No. Okay, well, maybe if gold goes higher, it will. Well, what else could drag silver kicking and screaming? A move in copper. Because copper and silver at this point are basically, silver's more like copper than it is gold at this moment in history.
Yeah.
It's a conductor of electricity and everything else. Still has monetary component that may return at some point. You got people invest in silver, they don't invest in copper, but you get the idea. Gold goes higher because of what Powell's doing, all this kind of stuff, and goes to say 2,500. And if copper goes to $6 a pound, silver's not going to stay at 28, 29. Okay, it's just not. And so when it finally gets dragged kicking and screaming through that resistance level at 30, there's a really high likelihood it'll go to 34, 35 in relatively short order. That's going to have big impacts on the mining shares, and that's all something people should. So watch copper closely in the days ahead. The clear correlation between not gold and the gold miners or the ETFs, but silver.
Yeah, right.
So yeah, you get silver to run to 35 or 36, a miner's going to go with it. My guess is we will have let's say that plays out over the course of the summer. Powell starts cutting rates, you get this surge, we get into June, July, and this happens again. There have been a lot of peaks in the precious metals, short term at least, that have occurred in the summer months. Okay. This could be another one that wouldn't surprise me based on how these things have gone over the decade plus that I've been watching it. If it didn't happen again, you get this another big rush forward. Now this one finally silver's into the 30s. Everybody's excited. Here we go. And there's going to be people all over Twitter talking about silver going to 50,
right.
70. And it will. But my plan will be when that happens to maybe be a little cautious at that point. Because you know how it is. When everybody in this sector gets all excited, that usually is some kind of top.
In April, inflation slightly eased, offering some relief to consumers, although it remained above levels that would immediately signal an imminent interest rate cut. The Consumer Price Index, which measures the cost of goods and services at the point of sale, rose by 0.3% from March, according to the Labor Department's Bureau of Labor Statistics. While this figure was slightly below the Dow Jones estimate of 0.4%, it still indicates persistent inflationary pressures. CraigHemke expressed skepticism about the accuracy of economic data, especially during election years, suggesting that it may be manipulated to serve political agendas. He also noted that despite the perception that quantitative easing, QE measures may have ceased, signs indicate the possibility of another round of QE shortly. This could involve the purchase of long-term assets to stimulate economic activity. The Federal Reserve initiated its fourth quantitative easing operation since the 2008 financial crisis on March 15, 2020, announcing approximately $700 billion in new QE via asset purchases to bolster U.S. liquidity in response to the COVID-19 pandemic. This move underscores ongoing efforts by central banks to address economic challenges and stabilize financial markets amid uncertain conditions. Let's get back to the interview.
And the only way you can pay off or manage the debt is with the cheaper dollars of tomorrow. You pay today's and yesterday's debt with the cheaper dollars of tomorrow. And eventually, again, this is not next week, okay, or next month, but eventually they're going to go down the path of yield curve control.
Yeah.
Because they have to. Now, when gold took off, again, we started this by wow, it took off before the Fed even started cutting. On the 1st of March, it was Friday the 1st of March, gold shot $40 higher and closed at all-time and weekly high and daily high, like 2089, something like that. And then it broke out and went $100 higher the next week. But what happened on the 1st of March? Fed Goon Waller gave a speech. And he said, we want to do a couple of things going forward, at least what I want to do. He said, I want to roll us out of some of the longer term stuff into the shorter term stuff, which will uninvert the yield curve. But then that will also give us room for the next round of QE to buy long-term stuff. And everybody went, wait a second, the next round of QE?
What?
So what's coming?
I didn't know that it stopped. When did QE stop?
Well, no, exactly. And so what's going to eventually come? I mean, this is, again, it has to. Otherwise, the whole thing will do this. The banking sector, everything. Is they're going to be printing money to fund all the ongoing deficits. But then they're going to do yield curve control to cap. The Fed will just say, we are buyers above a certain level. We will always be buyers above 3% or whatever they decide it's going to be, just like the Bank of Japan has been. And when you get to that point, now all of a sudden you'll have sharply negative real rates again because of inflation, everything else. And that's when, every other bit of government data in an election year, Gary.
Yeah, exactly.
I mean, until this last report a week ago, what, every single headline jobs number had beaten expectations for 13 out of 14 months or whatever it
Mhm.
was, right?
Yeah.
Yeah, I don't think you can believe any of that. And again, you can go back, it's not just election year. I
Oh,
mean, how many times they have to manage whatever the basket of goods are in CPI anyway to
the
create this
hedonic
illusion?
adjustments, all
Yeah.
that good stuff.
And again, it all pieces together in the management of the debt, because if you can convince the market that inflation is only 2%, then you will buy treasury bonds at 3% or 4% or whatever, because you're
Mhm.
getting a positive real rate of return. But if they were to accurately report
Right.
what inflation really is, no one's going to buy a treasury at 3 or 4% except the Fed. And
Of course.
that's where we're headed. Your currency begins backed by gold so that people have confidence to use it
Right.
in trade for goods and services, and you hold it because it's got some value that
That's a
anchors it.
cycle. Yeah.
Right. And then the politicians get a hold of it and they want their power. So then they wanted more currency for their wars and their social programs and everything else. And eventually you go off the gold standard like Nixon did. And then you swing all the way over here to where the base thing's basically worthless. And then nobody wants it. And then all of a sudden you got to get some confidence again. And so it swings back over here and you back it again.
Yeah.
And that's the direction we're headed.
Insights into the broader economic landscape highlight skepticism about the accuracy of economic data and the potential for further quantitative easing measures. These factors underscore the challenges facing policymakers in navigating economic recovery. How will inflation dynamics and central bank policies evolve? What implications might these developments have for investor portfolios and market sentiment? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.